Meet a 53-year-old nurse living right here in Columbus, Ohio. After 26 years of working grueling long shifts and packing the same lunch, they've managed to save diligently from every single paycheck. By early 2024, that steady discipline built a $480,000 retirement nest egg. Then, a colleague shows them a new exchange-traded fund. The pitch is incredibly compelling. An 11% yield paying out monthly cash distributions. The ticker symbol looks respectable, and the website shows charts going up and to the right. Convinced, the nurse moves $320,000 into the fund before the end of the quarter. The reward is immediate. Every month, a deposit hits the checking account. Sometimes it's $2,900, sometimes it's $3,100. There's a spreadsheet tracking every single payment. For the first time in their adult life, they feel an immense sense of relief, like their money is finally working for them instead of the other way around. But the spreadsheet is missing a crucial column. Despite the constant checks arriving on schedule, our nurse is silently losing approximately $1,400 a month in real purchasing power. They just can't see it yet because the brain stops asking difficult questions when the deposits keep clearing. To understand why a smart, educated person ignores this mathematical drain, we have to look at the work of Richard Thaler, the behavioral economist who won the Nobel Prize for mapping human financial irrationality. This visualization shows what Thaler called the bird in the hand fallacy. Our brains are wired to neurologically process a smaller present check as a massive reward. It feels certain. It feels like proof we made a good choice. In contrast, the brain treats a larger future unrealized gain, sitting quietly in an index fund, as abstract and anxiety-inducing. High-yield funds leverage this asymmetry. By converting an uncertain future gain into a certain present payment, they satisfy our neurological craving for safety while masking the actual erosion of the account. To dismantle the illusion, you need to understand net asset value, or NAV. It is the per-share value of everything a fund holds. When a healthy dividend company pays you, that money comes from corporate profit. The share price holds its ground. High-yield funds operate on a completely different set of mechanics. Because pure yield funds do not generate enough actual profit from their underlying businesses, they have to manufacture the distribution. To keep the monthly checks flowing into your account, the fund is forced to sell off pieces of its own asset base. Take a look at this chart mapping share price erosion. A fund is priced at $50 per share, advertising a 10% yield. To pay out that $5 without genuine earnings, the share price declines to $45. The next year, $45 drops to $40.50. Notice how the 10% yield label stays permanently frozen. The calculation is always distribution divided by current price. As price falls, payout falls proportionally, preserving the advertised percentage while your principal vanishes. Then the hidden cost stack accelerates the damage. These funds carry high expense ratios, approaching 1%, which you pay before a single distribution is counted. Add in ordinary income tax rates on those payouts, and an advertised 11% yield is quickly slashed down to about 7.3%. The final mechanism closes the trap completely: return of capital. When the fund falls short of generating real cash, it literally takes a portion of the money you invested, hands it back to you, and legally labels it a distribution. You receive your own money back and pay no tax on it today. But in doing so, your cost basis in the fund falls dollar for dollar. By quietly lowering your basis, the fund guarantees you a massive hidden tax bill the moment you eventually sell your depleted shares. The common defense you will hear is that these funds use a special strategy to generate cash, typically covered calls. The fund holds assets and sells options contracts on them, collecting a cash premium up front, which they hand to you as income. This graph plots a standard market index against a covered call ETF. The upfront cash premium comes with a severe cost, surrendering the right to participate in the market's upside. When the market rallies 15%, the covered call fund captures perhaps 4% and flatlines. That gap represents stranded money. The premium is real, but in a bull market, the ceiling is where the wealth lives. The data proves this out. In 2024, financial researcher Ben Felix tracked 23 high-yield covered call ETFs over a 5-year period. After accounting for every single distribution received, those funds showed an average net asset value decline of 31%. Map that onto our nurse's portfolio. An investor starting with $100,000 collecting monthly checks finished the 5-year period roughly $59,000 behind a standard index investor who collected absolutely nothing and simply let the account compound. These monthly distributions function as a slow-motion retirement liquidation. They provide the feeling of steady income while systematically consuming the principal required to sustain it. A total return approach changes the math entirely. Instead of buying engineered payouts that consume your principal, you hold low-cost, diversified assets and create your own income by safely and strategically selling tiny pieces of your winning investments. This chart illustrates William Benjamin's 4% rule. If a portfolio compounds at 7% annually and you extract a 4% withdrawal, the math is self-sustaining. After 10 years, the total return portfolio is larger than it started, dwarfing the shriveled 11% high-yield portfolio. If you want genuine dividend income, the checklist is clear. Look for a payout ratio below 60% of trailing earnings, proving the check comes from actual profit. Verify at least 5 consecutive years of dividend growth, and ensure the expense ratio is under 0.2% to eliminate fee drag. Finally, demand the absolute absence of options overlays or covered call strategies. You want genuine income from genuine business earnings, without selling away the future appreciation you spent decades waiting for. Sudden market crashes are visible and painful, but a carefully engineered illusion that arrives on schedule can quietly empty a life savings while the investor smiles at their spreadsheet.